S&P made new lows in the after hours yesterday. Cryptos are getting absolutely decimated. I don't know if anyone's checked the crypto markets, but they are getting dunked on, right? They're down massively. We're down on a whole bunch of things, right? The small market cap stocks are getting killed. Everything's getting destroyed in this market. It's very scary stuff. So we're going to start off taking a look at some of the charts and just seeing what the heck is going on in today's times and talk about why a lot of this is happening. So there are a couple of reasons why we're moving down, right? First off, if you look at the S&P, we'll look at it over the past 90 days and just track how far down it is from the lows to the highs real quick. And good morning, everybody. First of all, good morning, Kitchener, Shadow Girl, Rocky Mountain Gobblers, Silver, and that's who we've got so far. So welcome, everybody, to the stream. And it looks like potentially the stream is not working very well. So what is going on? Are we live or what? Shoot, we might not be live. We might not be live. Okay. So, let's see. Shoot. Okay, so we are live? Okay, cool. Well, it doesn't look like it's working too good on YouTube's end. Maybe I'll refresh. Shoot, I was hoping to avoid issues today, but it looks like not only is the market crashing, so is my streaming software potentially, but I guess, okay, there we go. So now we're live. That looks better. All right, cool. So welcome, everybody. Hopefully it's actually going through. But anyways, the S&P is down quite a bit. And yeah, Kitchener, I don't know why it always starts when I'm already talking. It's just, I don't know, I click start streaming and I wait a second or two and start, but I don't know. I need to figure that out. Anyways, the S&P down from the highs to the lows about 7.7%. So we're getting pretty close to being down to correction territory, which is down 10%. But if you look at the Russells, at some of the smaller market cap stocks, you can see we're actually down quite a bit more than that if you look at the chart. So from the November highs, we'll pull it out to the past year. So the Russells is down from quite a bit, right? Down about 17.5%, almost 18% from the highs to the lows. And that also has some large-ish market cap stocks, right? It's not all minuscule stocks, but you can see that the smaller market caps are definitely getting hurt a whole lot more. They tend to be a little bit more volatile, and we have been going through some significant market pain ever since the Fed really started talking about interest rate hikes and inflation fears. And we actually have a very interesting event going on pretty soon. So on next Wednesday, January 26th, we have a Fed statement, a Fed press conference, and a Fed interest rate decision. So really impactful things are going to be happening at the Fed next Wednesday, January 26th. We'll definitely want to keep our eyes on what's going on. And it looks like people are potentially expecting the Fed to increase interest rates by quite a bit. And part of the reason is Bitcoin and other cryptos, if you take a look, they are down massively, right? They actually broke through the supports that they were holding at. Bitcoin's down 7%. Ethereum's down 8%, and this all happened over the past 24 hours. And we'll actually take a look at some of these cryptos because they are absolutely crashing, right? Now Bitcoin, since that article was written, now it's down 9.5%. Ethereum is now down 12%. So if you look at the Bitcoin chart, it is not pretty. If it would load, there we go. So you can see it looks like we just fell off a cliff right here, right? Bitcoin just started tanking around 2 p.m., 4 p.m., yesterday, and there's no end in sight, right? We don't know how low this thing is going to go. Ethereum is even worse for wear, right? If you take a look at Ethereum, it's down even more. So look at that, down 12%, blasting through the $3,000 support level down to $2,800. So hopefully we'll see an end to this. But basically, the reason this is happening is a lot of people like to put their money in cryptos because they think that inflation is going to be really bad. They think that the cryptos will gain value relative to how much cash will lose value. And now that the Fed is really potentially going to start raising interest rates next Wednesday, right? It might happen. If we click on this, we can actually see they've been keeping them pretty low for a very long time, right? Since 2020, they've been keeping them pretty darn low at 0.25. So if the Fed starts raising rates, that could be bad for crypto, is what a lot of people are fearing, right? They're thinking that if the Fed raises rates and there's less money in the system, then there's going to be less money flowing into these cryptos, and that's going to create potentially a bear market, and people are preemptively jumping on that and selling off large portions of their crypto portfolios, and we're seeing cryptos move down. But it's not just cryptos, right? People are worried about the Fed raising interest rates affecting the stock market too, especially those smaller market cap stocks, right? The smaller market caps have been getting decimated once again. If you look at the Russells over the past year, you can see that we're finally, it looked like in November, starting to break out of this perpetual stagnation that we had reached. And it looked like that was a fake out, right? It looks like maybe, tricked a bunch of people into buying in right at the peaks as people thought, finally, these small market cap stocks, they're going to take off now. And then they just crashed, right? So relatively detrimental stuff, and a lot of it is being hidden, right? If you look at the S&P, it doesn't look that bad, right? It doesn't look like we've had that much pain in the S&P. It looks like we're up pretty big over the past year even, right? If you look over the past 365 days, it still looks like the S&P is up. Let's see what it is. It's up about 16%, it looks like, even though we've fallen more recently, right, from the highs. Even though we've fallen 7%, it looks like we're still up about 16% on the S&P. But a lot of that is just because of those large market cap stocks, right? The Apples, the Amazons, the Teslas that are just pulling this whole market up, basically propping everything up, all the index funds, making it look like times are good. But I don't know if you guys caught my video yesterday, but more than one third of NASDAQ stocks have fallen by 50% or more over the past year, right? From their 52-week highs. So really scary stuff. And this is the kind of stuff that real retail investors are feeling, right? Because retail, maybe some of them, I certainly am putting some of my money into the larger market cap stocks, right? The long-term stocks like Microsoft and whatnot that I think will do well over the long term, that I'm not, going to touch in my portfolio, right? Just buy and hold and don't worry about them. But that's where a lot of the hedge funds are putting their money, right? They have a lot of money to put in places, and apparently they like the large market cap stocks right now. They think that those are going to be the most secure ones. Now, even those have been falling lately, right? The tech stocks, even those have been falling. So there's no telling when the end will be in sight. Hopefully, it will come sometime soon, right? Nobody wants this kind of market pain to last forever. But unfortunately, it's looking like that's going to be something that we're dealing with for a bit, at least. So we're currently seeing, unfortunately, a lot of stocks falling, more so the small market caps. A lot of people have been feeling that in their portfolios, definitely. Once again, more so retail has been feeling that in their portfolios. And it's definitely not an accident, right? My suspicion is, if you guys watched my video yesterday, my suspicion is that a lot of the hedge funds and index funds don't like that there are a lot of new investors in the markets, or at least they see that as an opportunity to do what they've pretty much always done, right? Whenever a bunch of new investors come into the markets for the first time, it seems like we then shortly after that, right? We shortly after that have a big crash that kind of discourages and dissuades people from investing in stocks over the long term, right? And that ends up benefiting the institutions and the hedge funds because a lot of them, they want to own the assets, right? They don't want people owning the assets. They want people putting money away in their bank accounts, holding cash, which we'll try to pull up a chart of what has happened to cash's value. Over the long term. We'll try to pull up a chart and see what's happened to the value of the dollar. Let's see this. So here's what's happened to the value of the dollar over the basically the whole history of it, right? So eventually, in the 1960s, this chart starts out, and the value of the dollar actually increased for a number of years, right? For decades, the value of the dollar went up and up. I believe we were on the gold standard or whatnot, but eventually, we just got into this perpetual downtrend where the value of the dollar, the purchasing power of the dollar, has just been crashing through the floor, basically as we're printing more and more and more, right? So the value of the dollar, right, currently today is worth $1. But if you look back into even just 100 years ago, right, into 1920, it was worth $13. So 100 years ago, the dollar was worth 13 times more. So you've lost 13x value if you're just holding cash. And granted, very few people are living 100 years and holding cash all that time. But even if you just look back into 1990, which wasn't that long ago, $1 was actually worth $2 back then, right? You could buy double the stuff. So if you're just holding dollars over the past 30 years, you've lost 30% or 50% of your purchasing power. So that's where hedge funds and institutions want retail keeping their money, right? They want them keeping their money in savings accounts. So Zach Taylor says, mother of all crashes coming? Maybe. We'll see. It looks like we've already seen the mother of all crashes. I mean, look at this. I don't know if you caught this, Zach, if you were in the stream a minute ago, but here it is, actually. More than 1/3 of NASDAQ stocks have slumped 50%, right? I think it's, 36%? Yeah, 36% of stocks have plunged at least 50% from their 52-week highs. A ton of stocks are down massively. So Heckler Coke says, hey, Rob, could you let me know the short interest on AVCT? We'll check that out real quick for you. AVCT. So, or is it ACTV? No, it's AVCT. Yep. Okay, so here we go. Short interest on AVCT real quick. Looks like it's increasing. Look at this. So, we'll pull it up. Up 4.47% today to 15.93%, almost 15% of the free float, 6.07 million shares short on AVCT. It looks like it increased dramatically as of late, as volumes increased. So, not sure what's going on with that, but an interesting one nevertheless. So, basically, a ton of stocks are down massively. My suspicion is hedge funds, institutions want to push retail out. If you look at some of the retail favorites, right? Like AMC, we'll pull up the chart of the past year. These have gotten hurt a whole lot more than 50%, right? Even not counting from the 52-week highs. Look at this. So from the 52-week high of AMC, AMC is down. Let's see, what we need to pull this chart down a little bit, but it's down 75% from its 52-week high, and even just since November, right? If you just look at the highs of November, so about 2 months ago, we're down 60% on AMC, right? You can look at Sundial and see a very similar thing, right? From our 52-week high, we are down, I think it's 86% if I'm not mistaken. We've got to pull the chart down just a touch. So we're down 87%. And from our highs of November, we're down 45%. So a lot of these stocks have been getting crushed. It's a lot of the retail favorites. I mean, you can see it with BBIG. We'll pull that one up too. Over the past year, its 52-week high, even though it's been pumping recently, right? It's been pumping lately. We need to get rid of this, but it has been doing pretty well as of late, right? It's more than doubled as of late. But if you look from its 52-week high, it's down, and this came in a couple months before November, but it is down even after this pump, up down 68%. And more recent pump that it had in October, it's down 54% from. So a lot of these stocks have just been getting crushed, basically decimating a lot of retail's accounts, right? Retail accounts have been plummeting. We've actually seen a lot of people exiting the market as of late, and you can tell that people are exiting the markets, right? This isn't all shorts just pushing AMC down. A lot of people are paper handsing AMC. A lot of people are dropping their Sundial. They're getting scared of potential. I mean, there is some reason to be afraid, right? The Fed is potentially raising rates. A lot of stocks could be doing somewhat poorly in that kind of environment. It might be the case that as soon as the Fed raises rates, you might start to see, kind of a sell the rumor, buy the news once the Fed starts raising rates. Nothing in the market makes sense, so we might actually start seeing stocks go up, especially if they don't raise them that much, right? If we see on Wednesday, when the Fed is going to release their interest rate decision, potentially they'll keep rates the same, right? I think a lot of people are hoping that they'll keep rates the same. Nobody wants to see these rates go up. Nobody invested in the markets, at least. But hopefully they'll keep them the same. That could be good for the market. But if we do just see them raise them by 0.25, which is what they'll likely do, right? I don't think they would just jump the gun on that and raise them by a ton. Then we might not see that much market pain continuing from that, right? I mean, obviously, no interest rate hike is good for the markets because that means borrowing money is more expensive. It makes it tougher to borrow money and invest and whatnot. It makes it more appealing to have some cash and just keep that invested. But in reality, who the heck actually wants to have their money sitting in a bank account earning 0.5% per year, or even 1 or 2%? I mean, the average return of the S&P, we can pull it up. The average return is about 12%. And if you look even though there are some down times for the S&P when it's not doing too good, it doesn't tend to be, for too many years in a row that we have negative S&P years, right? Oftentimes you see, I mean, during the Great Depression, things got pretty bad. You had minus 12%, minus 28%, minus 47%, and then minus 15% all in a row. And, obviously the markets got decimated. Then in 2008, there was only actually one red year for the S&P when it was down, right? It started moving down in 2007, but it still eked out a gain on the year of 3.5%. Then in 2008, it was down 38%, but the following year it was up 23% and then 12%, and then it looks like a 0% gain. It looks like maybe this is a glitch on the chart, but it looks like a perfectly zeroed out year for the S&P. But then you see many, many years in a row of big gains in the S&P, right? 13%, 29%, 11%. Then you're down less than 1%. Then you're up 10%. Then you're up 19%. Then you're down 6%. Up 28%, up 16%, up 26%. This year, 2022, we're already down 6%. So if you think we're going to end the year green, you're actually looking at a potentially pretty big gain. If you're buying when it's down 6% and then it actually ends green, you could really magnify some gains if you think that this year is going to be green. Potentially, there's the potential certainly for this year to be red. We're already red. We're already down 6%. There's no guarantee that we're going to see a green year this year, right? Especially with all of these inflation fears. But I will point out that unless the Fed is really going to increase interest rates by a ton, by 5, 6, 7, 8, 9%, then inflation is still probably going to be outpacing the dollar, right? So people probably won't want to just be holding cash. They'll want to find somewhere to park their money. They'd much rather have their money in assets, even assets like gold, right? Gold has been doing pretty good over the past month or two. It's been up quite a bit. The dollar has been seen some volatility. So we'll see what happens with the actual value of the dollar if the Fed does increase interest rates. I mean, who really wants to hold cash, right? Cash, in my opinion, is trash, and you can see why from that chart that I showed you a little bit ago of the value of the dollar. Let's see if I can find it again. Hopefully I can. Maybe I destroyed the chart. I might have gotten rid of that chart. So we're not going to find that chart. But basically, the dollar's been perpetually losing value. A ton of people have been just throwing their money wherever. The Fed has, or the government has been printing money, taking out debt left and right, hand over fist, and there's no reason to hold cash, in my opinion, right? The government's been far too irresponsible with it. I don't trust them to just all of a sudden stop printing money. I don't think it's going to happen. So I still want to be holding assets, regardless of what might happen year to year over the long term, right? Looking at this annual returns list, I accept that there are going to be some years when the markets are red, right? That sometimes they're going to be down 38% if we see a really bad year, like the Great Recession. Hopefully not. But, we could be down 6%. We could end the year down 12%. Maybe stocks will fall a little bit more. Obviously, the small market cap stocks might get hurt a little bit more than that. My hope is that won't be the case. I'm in this for the long term. I think that over the long term, despite the fact that some years stocks might get crushed, you can never tell exactly when they're going to take off massively, like what they did at the beginning of 2021. I mean, look at this. Sundial was down at the beginning of January. On January 27th, Sundial was down at 50 cents. And we're about to hit up January 27th of 2022. And it was less than a month later, it was February 11th, that Sundial was at $4. So if you look at this, Sundial gained over the course of less than a month, from January to February. Sundial gained, we have to move the chart over a little bit, but Sundial gained from around 50 cents to $4. It gained, it looks like it was up 675%. And that wasn't even the highs, right? That's what this chart's recording, but it actually got a bit higher than that. AMC, if you look back at what it was doing at the beginning of January, to the end of January, we're going to see how much AMC was up by. It looks like AMC was up. Got to get this on the chart. Okay, so AMC from around $2 to $20 was up 700%. So a lot of these stocks could certainly explode at a moment's notice, right? In less than a month, these stocks could be up massively, just due to hype, right? If we get the right environment and we get people throwing their money into the markets again, like what we saw at the beginning of January last year, we could, in a month, be far higher than we are, right? Just because we've been on this perpetual downtrend doesn't mean that it's going to continue forever. Obviously, some companies will go bankrupt, but you got to pick out the ones that you don't think are going bankrupt, right? If you pick a bankrupt company, then you lose, right? That's when you lose minus 100%. But keep in mind, even if you lose 100%, you probably shouldn't have all of your money in one stock, right? You probably should have it diversified across a couple of different stocks that you like, probably, hopefully more than 5, right? You don't really want 20% of your cash in one stock or another if you're being well diversified. Obviously, some people are going to disagree with that. Some people want to YOLO it all into one stock, and that's a way to do it. That's not my favorite way of doing it. I like the security and the certainty of having a decently diversified portfolio and not having to worry too much about one stock potentially just getting hammered by bad news after bad news and bad stuff going on. So I like to have my stocks a little diversified, right? I'd prefer to not have everything all in one and to have a wide range of stocks in a wide range of different areas and not worry about it too much. So even if one goes minus 100%, it goes bankrupt, there's still others that have the potential to go up 600%, up 500%. And we've seen it happen in, less than a year ago. We saw some of these stocks go up 500% in less than a month. And that completely wipes out. I mean, you can have, if you have 6 companies, right? If you're holding 6 stocks and 5 of them go bankrupt, you lose everything if you've equally weighted these things. And one of them goes up 500%, it wipes out all of the losses, right? You're at break even at that point. So one can really carry your portfolio, and it's most likely not the case that you're going to have 5 picks that go bankrupt, right? That's probably not going to happen, right? Even when a stock announces bankruptcy, it doesn't mean it's all over. We can pull out, where is Hertz? What's the Hertz? Oh, you know what? I think Hertz did eventually go bankrupt, so I don't know if we can find the chart. Let's see. Let's see. Hertz Global Holding. Maybe this. This might be it. Okay. So what is this? Is this really Hertz right here? I don't know. I don't know about it. I know that Hertz, the car rental company, announced bankruptcy at one point. I haven't kept too close track of it, but it declared bankruptcy. And after that, it skyrocketed, right? And it made no sense, but people just piled into Hertz stock. And they may have been able actually to avoid bankruptcy because of it. I think they may have actually been able to do share offering and raise some capital, so they may not have had to go bankrupt. But that goes to show you, the markets are crazy and they're never hopeless, right? There's always the hope that something can come back. And BB says, Rob, keep a fresh cup every morning. I certainly have my fresh cup of coffee. And I do enjoy it every morning. So also, guys, I have to let you know, outside of this window, there is a winter wonderland. We just got a bunch of snow, not a ton, but more snow than we've had all year. So I will be ending the stream at 10 today, right? I'll be ending the stream at 10, hopefully just trying to blast through all my work and get out there and enjoy the snow. So just so you guys know, out there's a winter wonderland. We don't get snow all that often in North Carolina, so that's my plan. Just so you guys have a little bit of time to brainstorm other things to do for the last, from 10 to 10:30 when the stream would normally be on. I'm just letting you guys know ahead of time. The stream's going off at 10 today. I'm going out and playing in the snow. So, Zach Taylor says, Rob, I'm surprised you haven't mentioned Netflix. Netflix, I think, is Netflix down a bunch? I saw a little story on CNBC. I think, Netflix got hammered. I'm glad, I'm very glad that I sold my Netflix a couple of days ago. Look at that. Horrible earnings, it looks like. And I think they said something along the lines of the streaming competition has really slowed their growth, right? That's what they said on CNBC at least. So, yeah, look at that. Netflix down, looks like by about 20%. Look at that. Netflix getting crushed today. So let's see what they're down by. Right before the earnings call came out, they've fallen by, 21%. Horrible stuff for Netflix. We're also going to look at Peloton in a second. But Yeah, Netflix, it looks like, is down, obviously. Netflix had a huge advantage in the streaming area when it first came out. It was pretty much the streaming giant, and it enjoyed growth, massive growth for many, many years. And it's long been my suspicion that Netflix was getting to a point where it was potentially a little overvalued. I think I sold my Netflix for like 550 or 600, something like that. And I didn't actually ever buy Netflix stock. I actually just got it as a referral stock on Webull. So if you guys want, let me pull this up, you can go to the description of this stream if you wish. And I'll pull it up real quick for you guys. Pull this up. So here we go. So in the description of the stream, if you guys want, you can get up to, I think it's up to $3,300 worth of stock now on Webull. I got a share of Netflix from it. Now you get 3 free stocks when you open and fund a new account. So go ahead and do that if you want. If you want to support the channel, I got a share of Netflix, and it was like $600 at the time. It went down a little bit to $550, I think, and I ended up dropping it. But if you guys are interested, that's in the description of the YouTube stream, the Rumble stream, all that. So I'm sure glad that I sold that a couple of days ago, because I've long been thinking that Netflix, probably not the best buy, because it is a streaming giant, but it really got started early. We've seen massive growth with it. And now we're starting to see a bunch of other streamers come into the space, a bunch of other streaming platforms come into the space, right? Disney Plus, Hulu, HBO Max, all of those. Now you need a ton of, and even Peacock, I think, is CBS's streaming platform that has The Office and whatnot. So there's a bunch of different streaming platforms out there. And Netflix ain't anything special anymore, right? I've been long been thinking that there's nothing good on Netflix, right? I mean, they've got Witcher, right? Witcher just came out last December. That was very enjoyable. They've got a couple of things, but they're really running out of room to grow, it seems, right? They've already reached the peak in the US, it seems. I don't know how many people haven't heard of Netflix and haven't considered getting Netflix, and how many people don't have it. It seems like they're really starting to max out on what they can do revenue-wise in the US. Maybe they can expand into other countries. They've certainly been trying to do that, but now there are so many streaming platforms competing with them. They're not the best buy, in my opinion, right? We might be beginning a more long-term downtrend of Netflix. Maybe we'll get down to the 200 area eventually in a couple of years from now. It looks like they're sitting around 400 now, but we'll see what happens with Netflix, right? I'm not too worried about it. It's not one of my favorite ones, favorite stocks out there. It's certainly a great business model to get in the beginning, right? When it was going up for years. But Manny C says Netflix just raised the price again. Yeah, so that's something, right? That's how they're probably going to have to raise their revenues from this point onwards. They're probably just going to have to keep raising the price, and eventually people will get fed up with that, right? Now I think they're charging me $15 a month. It used to be 10. So we'll see if I keep my Netflix, right? I hardly ever watch it. Every now and then a new show will come out, like The Witcher, and I'll watch that. But overall, I'm not the biggest fan of Netflix, right? I'm typically not clamoring to log into Netflix every night and watch something. The shows, every now and then they get a good one, but overall, I'm not watching Netflix that often. It's probably not worth the $15 a month that I'm paying for it. So speaking of another stock that crashed, I did want to cover this real quick. Peloton. So Peloton, just to give you guys the backstory on this one, did incredibly well during the pandemic when everyone was in lockdown. They were selling a ton of these. I'll pull up their website. Real quick. They're an exercise equipment company, and basically they sell these bikes. Here's their website right here. They sell these bikes and treadmills and some other workout stuff. But the way it works is you buy this thing for quite a bit. We'll click on the bikes and see how much they cost. I think it's $1,400. Maybe they lowered their prices. Let's see. So yeah, $14.95 for the Peloton bike. And then you have to, I don't know if you have to, but you probably should, if you got the Peloton bike, subscribe to their monthly service for $39 a month. So more than most gym memberships. You have to pay to get these online classes streamed to your screen. And it just seems like the worst thing ever, right? You're paying $39 a month so that someone will stream an online class to your thing when there's a ton of free ones out there on YouTube and whatnot. And granted, it's live and all that, but $39 a month seems like a whole lot to pay for that kind of a thing, right? That's extraordinary what they're charging. When you already pay $1,500 for the bike, right? It should probably, if you're paying $1,500 for the bike, maybe it should include these classes for free for a year, something. But anyways, they're charging a ton, and if you get the Peloton Plus, it's $2,559 a month. So that's what Peloton does. That's why they were doing incredibly well during the pandemic. They just about 10x from $17 to $171 at the peak of the lockdowns and all that. A ton of people were buying up these bikes. They all wanted to get their workouts in from their homes. And we've recently seen a big crash with Peloton. Even yesterday, if we pull out the 5-day chart, we saw a massive crash with Peloton as they announced this right here. So obviously they hadn't been doing good for the past while. If you look at the past year, they'd been falling quite a bit, but they announced a halting of production of their bikes and treadmills as demand is waning. So people have not been buying enough of these bikes and treadmills because, once again, it doesn't seem like the best product, right? It seems kind of pointless to be buying these bikes and whatnot if you still have to pay such a massive fee. It seems a little pointless, but they halted production basically because of that. And of course, I've missed the first couple minutes of market open. So let's see what's going on in the markets. We'll pull up some of the charts. It looks like AMC just hit new lows on this downtrend. Look at that. Today, 1763 on the first minute of market open. AMC hit new lows, but it looks like we're seeing some green on AMC. Hopefully that will continue to be the case. And Zach Taylor says, if Peloton was smart, they would turn their bikes into Bitcoin miners. That would be awesome. If they, if while you were pedaling, you were generating the electricity to mine Bitcoin, that would save the company right there. So, and then it sends it all back to Peloton, and you still have to pay $39 a month. That would be perfect. So the S&P looks like it's doing fairly well. It's pretty green today. Well, not today, but over the first couple of minutes the last couple of minutes of the pre-market and the first couple of minutes of market open, it looks like we are trending up, but it is notable that we made new lows, I believe, in the after hours. And hopefully we won't see more new lows, but with this Fed decision coming up, you never know, right? It seems like we're probably going to potentially trend a little bit lower if the Fed comes out and says that they're raising rates. I don't think they would want to, but obviously they don't want the market to crash, but they've got to do something about inflation. AMC up 1%. DWAC looks like is getting a bounce off of $80. So good stuff. We're up 3.3% with DWAC. Sundial, very interesting situation with Sundial. So Sundial is moving down, and it seems potentially likely that we'll move below 50 cents today. Reason why? If you look at the options chain for Sundial, the only options are expiring today, by the way, and the only call options that are left in the money are the 50-cent strike price call options. We've got about 93,000 open interest call options at the 50-cent strike price. And wouldn't it just be great for the institutions and the hedge funds that were selling these if Sundial dipped below 50 cents and none of those call options were in the money? That would be great for them. They would love to see it. So it would not surprise me at all to see potentially a couple more shorts coming into Sundial, just enough to push it down below 50 cents for the end of the day, so that those options all expire worthless. That would be nice for them. So they'll probably want that to happen. Now, we'll pull up the short interest on Sundial. It looks like we are slightly up. Short interest change wise up 0.3%, up to 13.63% of the free float. 279 million shares short, and we have been ever so slightly increasing over the past week or two. So some more shorts coming into Sundial, but not a ton. We're still fairly low regarding where we've been historically over the past many months. So Tyler Mike says, if the Fed is raising rates, it means the economy is doing good, Rob. FUD spreader. It's actually interesting. Typically, they will be raising rates when they're looking to put a damper on things. And if you look at the S&P, we are doing pretty good on the S&P. But once again, a lot of those gains are in the larger market cap stocks. And if you take a peek at this, which I don't know if you were in the stream when we first showed this, but more than 1/3 of NASDAQ stocks have slumped 50%. This came out just a couple of days ago, about a week ago, this report came out. More than 1/3 of NASDAQ stocks are down 50% from their 52-week highs. And you would not know it by looking at this S&P chart, right? Where we're pretty darn close to all-time highs. We're not that far off. We've moved down from all-time highs about 7%. But more than a third of NASDAQ stocks are down 50% from their 52-week highs. So the large market cap stocks are really covering up a lot of pain in the markets, right? A lot of potentially retail pain in the markets. If you look at some of the smaller market cap stocks, they have been getting decimated lately. And we'll see what happens. If the Fed raises rates, it's not necessarily because they want stocks to move down. It could be just because they want inflation to be less of an issue, right? That's my suspicion. And Tyler Mike reiterated his comment in all caps. So they slumped because of hedge funds. Yeah, I mean, the hedge funds, they've been shorting. Don't get me wrong, they've been shorting, making money on this push down on a lot of these stocks. But to be fair, yes, the S&P is green, right? But overall, there's quite a bit of pain in the market. So the interest rate hikes that we might be seeing soon are probably more so to combat inflation than to slump stocks down further. Because we're already seeing, right, some pain in the markets, right? The markets are moving down. The S&P is lower than it has been since October. So October was the last time that we were this low. So we are moving down in the S&P even. And if you look at the Russells is getting crushed. Look at this. The Russells is down. This is tracking some of the smaller market cap stocks. From its highs, it's down almost 20% and lower than we have been throughout all of 2021. So, if the Fed raises rates now, it could be an indication that maybe it'll be an inflection point. Maybe if this is a sell the rumor, buy the news situation, maybe stocks will turn around and start moving up as the Fed raises rates. Particularly, that could be possible if they raise them by not that much, right? People might realize the Fed is being a little bit of a baby, not raising rates all that much, and that maybe there's not too much to fear in the markets and stocks can start moving back up. That's the hope, right? I would hope that would happen. We'll see, right? There's obviously a lot of fear in the markets. If you look at the VIX has been soaring lately. It's been going up and up. It's up from the lows about 60% as of right now. So from where it started the year on 1/1 or 1/3, I guess, we're up 60% on the VIX, and that's the market volatility index that tracks market fears essentially, right? So the higher this is, the more fearful people are, and you tend to see this moving up synchronously as the markets move down. So we'll see what happens with the VIX. Obviously, it's pretty high. There's a lot of fear out there, a lot of volatility. And notably, the S&P is seeing a little red day to day. I think that oftentimes, before the Fed potentially raises rates, you'll see the S&P moving down just to generate a little bit of fear at the Fed, right? A little bit of fear that they might be making the wrong call, that the markets might need a little bit more support. Maybe they shouldn't raise rates. That's what I think a lot of the big players end up doing, right? They kind of sell off stocks, they short stocks to push the markets down to kind of punish the Fed, right? When the Fed starts talking about raising interest rates, the big players who are borrowing a ton of money don't want to start paying more interest on the loans they've taken out, so they start to sell off some of their stocks and punish the Fed. That might be what we're seeing today. So that's an interesting situation we could be looking at. We'll see what happens with the S&P on Wednesday when the Fed is going to be making their rate hike decision, right? That's when we're next expecting it. And you can see that so far they've been maintaining a fairly low level, right, of 0.25. Very, very low, actually, right? We rarely have interest rates this low, historically speaking. They used to be much, much higher than this, and we've kept them low for many years. And it would be surprising to see, since 2008, they were kept pretty low all the way until 2015. And it would almost be strange to see them rising so quickly, to see them get raised so quickly. But we'll see what happens, right? There's obviously been a lot of inflation that people are worried about. And if anything was going to get those to move up, then it would be the inflation situation, which we're finally looking at. So DWAC looks like we just broke through $80 support And we've done this day after day, right? We've played around the $80 level for the past 2 days, so not surprising at all to see us continuing to play around that. We'll probably continue to play around it for a bit. Hopefully we don't fall down too much, right? Hopefully we stay at a fairly secure $80 level, right? Now, I do want to point out, just for those of you who are interested, Tyler Mike says, Fed raising rates has nothing to do with the market. The press has everything to do with the market. It's all a story. How do they want to spin apps? Yeah, definitely. I mean, that's definitely part of the case, right? The the news definitely has a big impact on the market, right? How people perceive the rate hikes and all that. If they perceive them as a good thing, potentially, it could boost the market, right? If they spin the story to be, it's really great that the Fed is raising rates and keeping inflation under control so that the markets can keep doing incredibly well, then maybe we'll see the markets rebound a little bit on that news. So it could be good, right? It could obviously be a sell the rumor, buy the news situation when we see the rate decision come out. If it is higher, we might see the markets moving up. So what else we've got? So I did want to look very briefly at a pretty cool story, in my opinion. So for those of you who haven't heard of this, Elon Musk's brain implant company, Neuralink, is inching towards human trials. And the reason this is so cool is because, in my opinion, this is one of the best pieces of technology we're going to get over the next 50 years. One of the most impactful pieces, right? This could potentially be the new smartphone, and a whole lot better than that, right? So Neuralink is essentially, a computer chip or whatever it is that he's developing that you put into someone's brain. And initially it's going to be used to deal with issues like Alzheimer's and Parkinson's. And it'll help stop degenerative diseases and all kinds of stuff like that. But eventually, the goal is to develop it to the point where you can actually improve a normal person's brain function by putting a computer chip in their brain. And my suspicion is that this will be revolutionary, right? That people are going to start putting these chips in their brains, becoming super geniuses, and being able to think about things really quickly and just, instead of searching for something on the internet, you can just blip it into your mind, and you'll have access to all kinds of information. Obviously, you'll have to worry about it getting hacked and all that, but it's really cool that they're getting towards human trials. So Elon Musk's brain implant company, Neuralink, is now hiring a clinical trial director, an indication that the company's long-standing goal of implanting chips in human brains is coming closer. So really cool stuff. I'm very excited to see it. And, just wanted to point that out, that Neuralink is a thing for those of you who didn't know about it. It's pretty cool. And Shadow Girl says, Rob, please do not push the NWO with those chips. What is NWO? Let's see. New World Order. Oh, I see. Yeah. I mean, obviously, it seems like a kind of sketchy thing to do. If there's anyone that I trust to do it, it's Elon Musk. So we'll see. I definitely won't be the first adopter of it. But we'll see what kind of benefits they can impart. A lot of people aren't going to want them. They're not going to be a fan. But we'll see. We'll see what happens with them. So hopefully they won't be they won't be used for nefarious purposes. But you never know. It looks like, okay, look at this. Talk about nefarious. Sundial is also dipping below 50 cents. So it looks like those call options on Sundial are all out of the money, and market makers and institutions and hedge funds are loving it, right? They want those all out of the money to be worthless. So that's what we're looking at with Sundial. It looks like the yearly call options for January 21st of 2022 will all be expiring worthless on Sundial. And what better way to take retail's money than to make all of these hundreds of thousands of call options expire worthless, right? You can see 93,000 at 50 cents, 307,000 at $1, 135,000 at $1.50, 91,000 at $2, 37,000 at $2.50, 56,000 at $3. You're looking at 132,000 at $4, and 116,000 at $7, all expiring worthless. And obviously, they're all valued at $0 right now, but when people bought them, they were probably valued much higher. And that's actually one of the reasons why I like selling options, right? Not call options in particular. I prefer selling put options because you can collect quite a premium. And we'll look at that with DWAC and how you could potentially collect a premium with these options on DWAC stock if you want to take a bullish position on it. So what I've done, and I'm actually up fairly significantly on these options at this point, is way back when DWAC was trading closer to 50 bucks. If we look at the DWAC chart over the past 30 days, it was trading around 50 bucks for a while, right? It was trading down here. And if you look at the options, the $50 call options, you could have sold for close to $35 is where I was selling them. So you had a break-even price of 15 bucks. So basically what that means is if you sold these put options, the $50 put options, you collected $35 right off the bat. Someone handed you 35 bucks and said, now I have the right to sell you DWAC for 50. But you've already collected the 35, so really you'd only be paying 15 to buy it. So if you thought that over the course of the next year, into January 20th of 2023, DWAC was going to fall below $15, then that wasn't a good trade. But if you thought it was going to stay anywhere above 15 bucks, you're making money. If you thought it was going above 50 bucks, you're doubling your money. If it was just going to stay above 50, now we're at 80. I've already made some money on the trade. I'm considering selling some more of those put options, especially as we see red days like today. Look at this. DWAC down 5% just about. So, it's a potential opportunity. Now, I hate to be that guy, guys, but we've got 80 likes, or we've got 80 viewers on the stream, 42 likes. Maybe we could bump it up to 50. If 1 out of 10 people like this thing who's watching, we could bump it up to 50. We only need 8 more likes to get there. So potentially we could do it. We'll see. No guarantees, but we'll see what we can do. On both Rumble and on YouTube, right? We've got about 20 people on Rumble watching too. So any additional likes would definitely help out the algorithms. Just to help get this stuff out to more people. That would be much appreciated, guys. So it looks like the S&P it can't decide what to do. It's just bouncing back and forth, back and forth. Sundial, looks like the market makers decided they wanted it below 50 cents, though. And DWAC might be coming back up to 80. We'll see what happens with it. AMC, look at that. They faked us out. They made us think that AMC was going on a big rally, maybe a home run back to $20, and then they started crushing it again. So look at that. Looks like they're just trying to scare more and more people out of the markets by crushing a lot of these stocks, a lot of the retail favorites. And look at that. All these stocks moving down, DWAC, Sundial, AMC, as the S&P actually begins to rebound. So probably the larger market cap stocks are the ones responsible. We can pull this up on FinViz. We'll see. Yeah, look at that. So overall, there's some significant red in the markets, right? There's some red, there's some flecks of green, but Apple, Microsoft, even Google and Facebook to a slight extent, Tesla also, little green. Amazon's the red one. Nvidia has been doing kind of horribly lately, right? They've been doing pretty horribly. If you look at their long-term chart, one of my friends was asking me this morning if he should sell his Nvidia stock because he's down 24% on it. Look at this, the Nvidia chart over the past year in the bottom left. Look at this. They were soaring. And, along with the markets, they have been not doing great lately. So from their highs to their lows, let's see. They're down 32%. So, man, my friend must have been catching this thing close to the top. Yeah, look at that. He must have been buying right around 320. So look at that. We're not doing too good on Nvidia stock, I'll admit. We're pretty low with Nvidia. So, maybe it's a buying opportunity. Maybe we'll move down further, right? Nvidia, obviously, if we look at their market cap and their PE ratio, it's fairly high, but it might be getting a little bit more reasonable as of late. We'll see. So look at that. Just a week or two ago, their PE was 80. Now it's 73. So their price earnings getting into a more reasonable area. Not incredibly reasonable, but they're a fast-growing company. Semiconductors and all that and chips are important. So we'll see what happens with Nvidia. So hopefully good stuff. Netflix is still going. AIAD moving up again. And Nvidia will go back, says Vivi. Yeah, so yeah, I think, obviously over the long term, right? If we take a peek at the max chart, there have been dips on Nvidia before, right? You've seen big dips on Nvidia. This one looks more significant. It looks fairly significant, right? So down 30%. That's happened very rarely. Last time that happened was in 2018, it looks like. Let's see how much Nvidia was down in 2018. So it was down 55%. So Obviously, a lot of tech stocks got hurt towards the end of 2018 when the Fed was raising rates, and they decided to cut the rates when they saw all this market pain. And it did save the markets. We had a great year the following year. The year after that, an even better year. An amazing 2021 for a lot of these stocks. And 2022, not off to the best start, right? We're starting to move in a fairly negative direction with a lot of these stocks. Hopefully, it doesn't continue to be the case that we're perpetually losing value on these. But it's a it's a distinct possibility that we could see. Hopefully, that won't be the case. But a lot of these stocks just getting crushed at the beginning of 2022. I mean, what's AMC down? Look at this. The past 30 days, what is AMC down since 2021 began? That'll be interesting to see. AMC is down since the start, since it opened at 2021, it's down 36%. So down quite a bit. Down quite a bit on AMC. On the SPY, what are we down? Since the markets opened in 2021, well, we already kind of saw it on that average S&P gain chart, but now we're down 6.79%. So quite a bit on the S&P as well. That's fairly significant for an index like the S&P, especially when you look at the past 2 years, or even I think if we could pull up the 3-year chart, other than the initial surge of the pandemic, we've just been moving up and up and up and up and up in a fairly straight line. Obviously, there have been some hitches along the way, but we are moving down fairly significantly now. So we'll see. If this continues too much further, it could get pretty nasty, right? People aren't at peak fear yet, is my suspicion. You don't lose money unless you sell, Rob. That's exactly right. Tyler, you should check out the video I released yesterday. It's called AMC and Sundial. They want us to sell, right? You should check that out. I'm definitely a proponent of holding, right? I think that's what I'm preaching right here. I think holding is the way to go. Obviously, not financial advice, but I think that a lot of the times it's really tough to time the markets, and if you stick in it for the long term, let's pull up the S&P historical data that we've got. So you can sell when you're down big, but then it's likely that the next year you would have been up big, right? So if you look at the long-term performance of the S&P, you can see that there are down years. It's not green every year. It's not on average. It's not that every year the S&P moves up 12% and those are your gains, and that's how you have the 12% average gain on the S&P. Oftentimes it's up 37%, 46%, 27, 41, 12, 19, 13, 30, 45. You see a bunch of big gainer years in the S&P, and then you see some loser years, right? Down 47%, down 38%, down 29%, down 17%, down 38%. We're starting this year off down about 6%. So it's not a guarantee that you're going to see green every year, right? Like a lot of people have been getting in the markets lately, looking at the past couple of years of performance, just assuming, well, every year it's green. Look at this. I mean, you can't lose. You never lose on money, right? Stocks only go up. That's what they've been assuming. Just because shy of this, right? This drop for 2 months, and then incredible green months following that. Shy of that, we haven't really seen any significant drops that would really scare anyone out of the markets. This could become one, right? We could see a little bit of a further dip, really scaring people away from stocks, and it'll be interesting to see how cheap we can get these things. In my opinion, it just presents better buying opportunities, but not everyone views it that way, right? Some people view it as this is when I want to sell because they can't handle the psychological stress of looking at their portfolio every day and seeing a lower number. But I think what's important to note is that investing is a long-term game. Let me see if I can find a compound interest calculator. We'll see if I can find this. So this should be good. Hopefully this will be a good one. So we've got this compound interest calculator on investor.gov. So let's say you have an initial investment of $10,000, right? And maybe every month you put in an extra $100, right? That's doable for most people. Most people could do that. Obviously, some people can't just start out with $10,000, but let's say you could, right? Let's say that in a year from now, if your goal is to save up $10,000, then you can start with 10,000 bucks, and then put $100 in every month after that. It's not that much, not that bad of a hit to take, right? To just put $100 in, and length of time in years. Well, we'll fill that out. We'll mess around with the years for a couple of times. So let's say you're just getting the average of the S&P, right? If you just buy and hold the average, you get 12%, and we're not going to mess with the variance. Let's just put that at 0. Now, the length of time in years. Let's say you're saving let's say you do it for 20 years, right? Maybe you're 30 and you want to see what you can get it to at 50. So we'll calculate this. If you just started with that 10,000 and put in $100 a month, you'll have 182,000 at the average S&P return rate for just 20 years. Now, maybe you want to do it for 30 years. Maybe you're 30 and you want to go to 60, right? You want to retire at 60. You have 589,000. Incredible gains. For those of you who haven't played around with compound interest calculators, it's really cool stuff. Now, maybe you're 20 and you're going to 60, right? Maybe you're 20 and you want to have money when you're 60, and you're putting in, 40 years of time in the market. You start with 10K, put in $100 a month. Let's see okay, look at that, $1.8 million. And this is a pretty low amount, right? I think most people can probably outperform the contributions, right? I mean, $10,000, that might be a large lump sum for a lot of people to just put in the markets, but $100 a month is very doable. In fact, let's look at this. Let's see what happens, if you start with $1,000 and maybe you put in $300 a month, because you can do it, right? That's only $3,600 a year. If you're making $50K a year, it's not that much of your overall income. It's some, but you should probably be trying to save a decent amount. So $300 a year, you start with $1,000, or $300 a month. You start with $1,000. Most people can do that, right? Let's see what it would be over the course of 40 years. You get $2.8 million just buying and holding, right? That's on average what the S&P does. So you end up making quite a bit just being in the markets over the long term, not worrying about the volatility. Because once again, I mean, that's the average return over this time period that we're looking at, about 12%. So, even though there are some years when you're down 47% or 38%, or 23%, as long as you're not selling and taking your money out during those years, and that's not the year you're planning to retire in, you're sitting pretty with all that compound interest. So once again, for anyone who hasn't played with a compound interest calculator, it's pretty cool stuff, because I mean, you could really take it to the extreme and say, oh, what if I have $25,000 that I have just laying around, and I want to maybe you have a good job and you want to put in $500 a month. Some people can absolutely do that. Over the course of 40 years at 12%, what could it be? It could be $7 million over the course of 40 years. So, some people can absolutely do this, right? This is well within reach for a decent number of people, especially if you're living in the U.S. You probably you could have a decently high-paying job, and you could probably put away $500 a month. Not everyone can do it, but that's only $6,000 a year that you're putting away. So my point is that over the long term, if you look at the max, look at the S&P, right? Sure, there are a couple of years in a row when it might be moving down, when you might see some red in the markets. But overall, if you're looking at this chart, look at the beauty of how much it rises. I mean, we can't even fit the whole chart on this thing. The chart literally has to expand the y-axis just to show you how high we can get. Look at that. We're about 10x from where we were in 1993. So in less than 30 years, we've 10x the money, and that's just putting it in the S&P and not touching it, right? That's not even actively investing and trying to pick out winning companies like let's pull out Microsoft real quick. If you bought that in let's look at 1993 so that we can track it alongside the S&P. If you bought Microsoft, you're buying it for $2.92. So now it's at $299. So it's about 150x if you bought into Microsoft, and that's even after the dip that it's been on, right? It was up at 340 more recently, right? So we're down a little bit on Microsoft now, but it still would have been an absolutely massive gain over the long term, right? If you bought into that instead of the S&P. So there are opportunities out there. You can definitely make a lot of money over the long term, just putting money into the markets, not worrying too much. And Travis Bruce says, Dave Ramsey just took over Rob's body. Maybe. I guess that is. I don't listen to too much Dave Ramsey. Maybe that's something he would say about just putting money into the markets. I think he tends to preach the whole no debt approach. I don't know if that's necessarily the right thing to do, right? Because once again, pulling out this compound interest calculator, you can make pretty massive money in the market. And sometimes you might be faced with the decision of, do I want to pay off my mortgage early when it's charging you a 3% fixed rate or 4% fixed rate of interest per year, or do I want to put money in the markets and watch it potentially grow, potentially shrink in some years? But I tend to be of the opinion you don't necessarily need to pay off all your debts if the interest is low. I think that sometimes you can take out those debts as long as it's money that you're not going to need to pay off very soon. If you can have enough of a safety fund essentially to pay off your debts for the next couple of years, at least whatever the payments would be on them. You don't need to worry too much about having some debts, in my opinion. It's not financial advice, just what I tend to think about it. I tend to be a little bit more on the riskier side, I suppose, of what Dave Ramsey would be saying. But that's just my opinion. Dave Ramsey, he's certainly done well for himself, but I don't think you're going to get rich, pinching every penny. Sometimes you got to spend money to make money. So, you're not going to get rich pinching every penny, but you can certainly do it. As we just saw on this compound interest calculator, you certainly can do it investing. And, maybe it's a good investment to pay off your mortgage and whatnot, but that's what Dave Ramsey wants you to do. So other than that, guys, we are getting to 10 o'clock. And like I said, it is an absolute winter wonderland right outside that window. So I'm going to be ending the stream now. This is an early end to the stream. Typically, we go until 10:30, but we're ending it now. So that will be that for the day. We won't be doing... we aren't continuing this any further. So other than that, guys, hopefully you are going to see some green in the market sometime soon. Hopefully we'll all see some green. There's no guarantees, though, right? We might see some red for a while. But the important part is that you don't worry about the red too much, right? And you don't sell when you're extremely red. Obviously, not financial advice. You can do whatever you please. But that's just my opinion on the whole thing, right? Over the long term, we've definitely seen periods of volatility. People have definitely lost money, both holding and selling. But only holding if the company eventually goes bankrupt, right? So other than that, we're looking to end the stream. Have a great day. Don't forget to join us every morning at 9 when we start these streams on Rumble, on YouTube. Maybe we'll start adding this thing to Twitch. We'll see what happens. But good day, everybody. Good day.